Capital markets. The following video is aimed to explain capital markets, introducing its concept, the entities or participants inside this market, the financial instruments given or categories, the two types of markets we have, primary and secondary markets, its difference with money markets, and final but not least, how it protects investors. This video has been made by Mireia Lorente, José Pedraza, and Raúl Villar. Capital markets are markets for buying and selling equity and debt instruments. Capital markets are the mechanism through which savings and investments are exchanged between suppliers and demanders of capital. Following the globalization process, capital markets have turned vital for the functioning of an economy. Capital is in itself a critical component for generating economic output. Many entities participate in capital markets, like individual investors, such as people, institutional investors, which can be pension funds and mutual funds, municipalities, so city council, and governments, companies and organizations, banks, and financial institutions. However, each group has different interests. Governments, for example, may issue debt through bonds. These are called government bonds, while it may not issue equity through stocks. Suppliers of capital, on the other hand, generally want the maximum possible return at the lowest possible risk, while users of capital want to raise capital at the lowest possible cost. In capital markets, there are two categories of financial instruments, which are equity securities, often known as stocks, and debt securities, often known as bonds. Capital markets consider stocks and bonds for medium-term and long-term durations, generally terms of 1 year or more. Capital markets include primary markets, where new stock and bond issues are sold to investors, and secondary markets, which trade existing securities. In primary markets, stocks and bonds are issued directly from companies to investors and other institutions. They allow companies to raise capital without or before holding an initial public offering, so as to make as much direct profit as possible. The secondary market, instead, is where investment banks, other firms, private investors, and a variety of other parties resell their equity and debt securities to investors. This takes place on the stock market or the bond market, compounded of exchanges around the world. When securities are resold on the secondary market, the original sellers do not make money from the sale. Now we move on to the differentiation from money markets. People often confuse or conflate capital markets with money markets, though the two are distinct and differ in a few important aspects. Capital markets are exclusively used for medium-term and long-term investments of a year or more. Money markets, on the other hand, are limited to the trade and financial instruments with maturities not exceeding 1 year. Moreover, money markets use different financial instruments than capital markets do. Capital markets use equity and debt securities, whereas money markets use deposits, bilateral loans, acceptances, and bills of exchange. Now, protection of investors. Investor protection is defined by the extent to which the commercial law and its enforcement protects investors from expropriation by company insiders. Investor protection is usually measured by indicators that quantify explicit protections awarded to shareholders and creditors by corporate, bankruptcy, and reorganization laws, as well as the quality of law enforcement. Examples of such explicit protections are those that impact the shareholders' ability to vote down directors, including whether to allow shareholders to vote by proxy or vote by mail. Allowing shareholders to vote by proxy or by mail decreases the cost for small shareholders to manifest their dissent. There are also provisions that impact the ability of secured creditors to take possession of their collateral in bankruptcy. Furthermore, in many countries there is an automatic stay upon bankruptcy, meaning that creditors cannot repossess their collaterals and reduces creditor protection.
Created using Powtoon.